Over the last century, massive technological leaps, like the electrification of the 1920s, triggered financial manias. Today, we see that pattern repeat in modern data centers. It leads to a central question for 2026. Is the U.S. stock market pricing in a new economic reality, or is it showing the classic signs of a speculative bubble? Right now, market optimism is high. The S&P 500 is trading at historic levels, supported by a narrative that a handful of mega-cap companies are entering a period of limitless growth. This chart tracks the Shiller P/E ratio over the last 100 years, measuring how expensive stocks are relative to historical earnings. As of early 2026, the ratio crossed 40. That's only happened once before, at the absolute peak of the year 2000 dot-com bubble. That high valuation creates a fragile market. We saw the result in January 2025, when a Chinese startup called DeepSeek released an efficient AI model at a fraction of the usual cost. That single breakthrough erased nearly $600 billion from NVIDIA's market cap in one day. This level of volatility suggests the market is currently pricing in absolute perfection, leaving almost no margin for even minor technical disruptions. To see where that risk is hiding, we have to look at the weight resting on the foundation of the stock exchange. Just 5 companies account for roughly 30% of the S&P 500. Rolling this timeline backward through the Nifty 50 and the post-2008 recovery highlights a distinct outlier. We're looking at the most top-heavy market structure in 50 years. Economists argue this concentration is happening because AI is a general-purpose technology. Like the steam engine or electricity, these are rare inventions that eventually change how every industry operates. These technologies always require a massive infrastructure build-out. In the 1990s, the telecom boom led to the laying of 80 million miles of fiber optic cable. The speculative rush crashed the market, but those cables became the physical backbone of the modern internet. Huge, concentrated spending on infrastructure is a required part of this cycle. The boom builds the foundation, even if the financial costs are dangerous. But we have to look past the hype of the late 90s to see how today's AI giants actually compare to the dot-com era. This chart compares the profit margins of the top 7 tech stocks in 1999 against today's Magnificent Seven. While the dot-com leaders often had no earnings, today's AI companies generate hundreds of billions in revenue with high profit margins. Those profits are being poured into a massive bet. In 2026 alone, big tech companies are projected to spend up to $700 billion strictly on AI infrastructure. But that spending hits a wall in the real world. Despite those hundreds of billions, roughly 95% of organizations using generative AI report they haven't seen a measurable return on that investment yet. But there are also real physical limits. AI servers are incredibly dense, requiring huge amounts of electricity and massive cooling systems that are pushing local power grids to their breaking point. Because the current grid cannot keep up, tech giants are now pivoting to secure their own nuclear power. It's a shift that creates new supply chain problems and a maze of regulatory hurdles. While tech profits are real, that $700 billion in infrastructure spending is a massive financial commitment. To justify current stock prices, corporate productivity eventually has to grow enough to pay it off. For investors, the next 2 years likely follow one of 3 paths. The bull case assumes AI successfully triggers a global productivity spike, allowing companies to grow their earnings until they match these high valuations. This is the Sequoia gap. For every dollar spent on AI hardware, the industry needs $4 in software revenue. If that revenue doesn't materialize, the bear case takes over. Valuations drop, and AI-driven layoffs hit consumer spending, dragging down the broader market. The base case is more nuanced. AI is a real, transformative technology, but the curve of actual adoption will be much slower and constrained by these physical bottlenecks in power and hardware. Over the next decade, AI integration becomes standard across global industries, but many companies currently riding the speculative wave won't survive the transition to actual profitability. Markets try to price the future before it arrives. The ultimate test for investors isn't deciding if AI matters, but calculating exactly how much of its success is already paid for at today's prices.